What happens when veterans lose the protection of the agency that keeps the banks and the mortgage companies in check? Now, this isn't a political video. I don't do that on this channel, but we can all agree policy changes impact real people, and it's important to understand what's coming so you can protect yourself. So in this video, we're going to talk about what you need to watch out for if Trump and Musk dismantle the CFPB, not from a political standpoint, but just from a practical one. Now, if you're not familiar with the CFPB, it stands for Consumer Financial Protection Bureau, and it was created in 2011 in response to some of the sketchy banking and mortgage practices that led to the 2008 financial crisis and the Great Recession. So think of it as a law enforcement agency for big institutions. And if CFPB goes away, here's the top 5 things you'll need to be cautious of to protect yourself. First is predatory lending, because if CFPB is dismantled, this is one of the first things that could make a comeback. I'm talking about subprime mortgages with sky-high interest rates, adjustable rate loans that doubled or sometimes even tripled in cost overnight, and even loans where you didn't have to prove your income at all. If you had a pulse back then, you could probably get a mortgage, whether you could afford it or not. And that's exactly how we ended up with the housing collapse. Some lenders literally steered borrowers away from safer fixed-rate mortgages and pushed them into risky subprime or alternative A-paper loans, even when they qualify for better options. Now, one of the biggest traps was adjustable rate mortgages, or ARMs. Now, these loans came with low teaser rates for the first couple of years to make the monthly payment more affordable. But when that intro period ended, the rate shot up, sometimes doubling the payment overnight.
How many loans do you write each month?
About 60.
Yeah. What was it 4 years ago?
10, maybe 15.
So how many of these are adjustable rate mortgages?
Well, most.
Oh, yeah.
Yeah, I'd say about 90%. Yeah, the bonuses on those skyrocketed a few years ago.
So people couldn't keep up. And when home prices stopped rising, they couldn't refinance, so foreclosures just skyrocketed. Then there was the no doc and low doc loans, which some people also call liar loans, where the bank didn't require proof of income, employment, or even assets. So borrowers could literally just state their income and lenders wouldn't even check. And brokers, they pushed these loans hard because they got bigger commissions, and some borrowers flat out lied to qualify for homes they had no business buying, or their loan officer just lied for them on their applications.
Please lie on for me.
So when the market crashed, these loans turned toxic and investors got left holding a bag on billions of dollars in bad debt. Now, another disaster was the negative amortization pick-a-payment mortgages. Now, these loans tricked borrowers into thinking they had a super low monthly payment, but here's what actually happened. The borrower could choose to pay less than the interest owed that month. And then that unpaid interest got added to the loan balance. So instead of their debt shrinking over time, it actually kept growing until their house was worth less than what they owed on it. And you couldn't refinance because no lender would touch them. And they couldn't sell the house because, again, they owed more than it was worth. So let's not forget about the junk fees and the hidden commissions. Lenders found every way possible to overcharge borrowers. One of the worst was the yield spread premium. Now, that's where mortgage brokers got these secret bonuses for putting borrowers into higher interest rates than what they actually qualified for. So borrowers thought they were getting the best deal possible because brokers shop around, but behind the scenes, they were getting ripped off from day one.
Look, I'm a yield guy. Okay. I make $2,000 on a fixed rate prime, right? But I can make $10,000 on a subprime adjustable.
And this is exactly why the CFPB was created, to kind of put an end to these kind of predatory practices. Now, today, most lenders disclose their loan terms clearly, and borrowers are protected from a lot of the worst lending traps that used to exist back then. Number 2 is deceptive mortgage servicing practices. So let's talk about mortgage servicing and some of the scams that left homeowners drowning in late fees or wrongful foreclosures and just all around bogus charges. Imagine making your mortgage payment, and instead of applying it to your account correctly, the servicer splits it into multiple partial payments, or worse, they just apply it to the wrong account entirely. And it causes late fees and credit issues for no reason. And in some cases, it can even put you on the path to a wrongful foreclosure.
What I've received is a court order signed by a judge. It says you are to vacate these premises today.
We were scared
this
of
home is owned by the bank.
So it's super frustrating and stressful, especially when the servicer doesn't want to fix their mistake. And this sounds so crazy that it's probably hard for you to believe that it actually happened. But go talk to companies like Aquin Financial Corporation, who CFPB ordered to reduce loan balances by $2 billion. That's billion with a B for this kind of mishandling of mortgage payments. Then there's the issue of loan modifications. So sometimes when people face hardships like losing their job or facing medical bills, they often try to get a loan modification to lower their payments. But loan servicers would just give borrowers conflicting information. They'd lose their paperwork on purpose to delay processing it or demand these trial payments that end up being denied for no good reason. Some of the servicers even kept moving forward with foreclosure proceedings while claiming they're working on your loan modification.
Damn you, Roger. Roger.
It's a nightmare for homeowners that are just trying to get a little bit of relief. The CFPB sued Aquin and Wells Fargo for this very thing, and Wells Fargo had to pay out $3.7 billion to settle widespread consumer finance violations, including wrongful foreclosures and loan modification denials. Now let's talk about forced place insurance, which is another scam. Now this happens when a borrower's homeowner's insurance policy lapses and the servicer buys an overpriced insurance policy on their behalf, sometimes charge anywhere from 4 to 10 times what the original policy costs. Now even worse, they would falsely claim insurance lapse when it really hadn't, just so they can make a profit from the insurance company affiliations or commissions they were getting. The CFPB went after JP Morgan Chase and other banks for this exact scam, and they were forced to pay out several $100 million to settle the lawsuit. In 2017, Aquin was sued for forced placing insurance on loans that were already paid off. Now, finally, we got escrow account mismanagement. Now, mortgage servicers are responsible for managing escrow accounts, which are used to pay things like your property taxes and your insurance. But sometimes servicers fail to make those payments on time, or worse, they overcharge the borrowers by increasing their escrow payments unnecessarily. So in some cases, servicers even divert the funds for their own purposes. Now, this can lead to unpaid property taxes or lapses in insurance, and homeowners can end up with unexpected tax liens or insurance gaps. Wells Fargo was fined $1 billion for this kind of mismanagement in 2018. Number 3 on the list is hidden fees and junk charges. Now, buying a home is already expensive, but lenders and mortgage servicers made it even worse by sneaking in hidden fees and junk charges that used to add thousands of unnecessary costs to a mortgage. So one of the biggest issues was inflated loan origination fees. So origination fees are supposed to cover the lender's cost to process a mortgage, but some lenders use them as a way to kind of pad their profits, and they would charge 2 to 3 times what was necessary. So back in the day on a $300,000 loan, that could mean an extra $9,000 in upfront costs for absolutely no reason.
Try the back bedroom. No room. Try the closet. We're gonna need a bigger boat.
Then there were those mystery fees and garbage charges, things like application fees, underwriting fees, funding fees, even rate lock fees for borrowers that were charged whether their rate was locked or not. And the charges had no real value, but they could add thousands of dollars to closing costs. And in the past, lenders counted on the fact that borrowers didn't know what to look for. And they used that to justify charging for things that should have already been included in their standard origination fee. Now, don't get me wrong. It's not uncommon for you to be charged a processing fee or an underwriting fee, but you shouldn't be charged these fees in conjunction with a large origination fee. So CFPB came in and forced lenders to justify every charge and disclose it up front on the loan estimate on the closing disclosure. Now, if that oversight disappears, we could see lenders quietly adding back some of these bogus costs, knowing that most borrowers won't catch on to them. And another shady tactic, the bait and switch pricing on interest rates. So lenders would advertise these low rates to get borrowers in the door, but then when it came time to close, they say, oh, well, to get that rate, you needed to pay X amount of points up front. Now, points, they can be useful when properly disclosed, but some lenders would overcharge borrowers or fail to explain the actual cost and trick people into paying thousands of dollars more for sometimes a rate that wasn't even all that competitive. And others would wait until the borrowers were literally at the closing table to raise the rate unexpectedly and force borrowers to either accept worse terms or restart the entire loan process. So CFPB cracked down on this by requiring full transparency and rate adjustments and banning last minute changes. So these days, if you make certain changes to a loan's terms, there's a mandatory waiting period before you can close. And it wasn't just lenders that were inflating costs. You had third-party fees were another area where borrowers got taken advantage of. Title insurance, appraisals, credit checks. These are necessary parts to getting a mortgage, but some lenders mark these costs up way beyond their actual price. And others force borrowers to use specific title companies or appraisers that charge excessive fees, all because the lender's getting a secret cut of the profits. So CFPB banned these kickbacks and required lenders to give borrowers the full freedom to shop around for some services. And in 2015, the CFPB hit PHH Corporation with a $109 million fine for violating the anti-kickback rules. Now, they were caught running a scheme where lenders steered borrowers into specific mortgage insurance companies, not because those companies offered the best deal, but because PHH was getting a secret cut of the profits. But here's where it gets interesting. In 2018, after a change in leadership at the CFPB, the case was completely dropped. Trump's CFPB appointee in his first term, Mick Mulvaney, dropped the case, effectively letting PHH off the hook. Fourth on the list is the weakening of the ability to repay and qualified mortgage rules. Now, the biggest difference between the mortgage market before the 2008 crash and today comes down to one thing: the ability to repay rule. Before the CFPB stepped in, lenders could approve a loan based on nothing but the borrower's word. No proof of income, no verification of debt, no real assessment of whether they could afford the loan. Now, these were called stated income loans, and they flooded the market with borrowers who were given mortgages they had no real chance of repaying.
Well, my firm offers ninja loans. No income, no job. You know, I just leave the income section blank if I want. Corporate doesn't care. These people just want homes, you know, and they go with the flow.
So to prevent that from happening again, the ability to repay and qualified mortgage rules were put in place. Now, these rules forced lenders to verify that borrowers could actually afford the mortgages before approving them. So that means proving income, checking debt to income ratios, making sure monthly mortgage payments, including taxes, insurance, and HOA dues, were realistic based on whatever the borrower's current financial situation was. And then there was the restrictions put on risky loan features. So before the crash, banks handed out interest-only loans, negative amortization loans, balloon payments. All this stuff made a mortgage seem affordable at first, only for the payments to explode later on. But here's the thing: the banks don't love these rules. They make it harder to push high-risk loans on the borrowers, and they limit how much profit lenders can squeeze out of the process. Now, are the mass majority of loans written today qualified mortgages? Yes, but that's because QM loans give lenders what's called safe harbor, which means they can't be sued for giving a borrower an unaffordable loan. And let's not forget the most dastardly of predatory loan features: prepayment penalties. This is a real thing, I promise you. Lenders would charge borrowers thousands of dollars in fees just for paying off a mortgage early. Whether a borrower was refinancing, selling their home, or they just got too far ahead on the payments. And what was super heinous is when lenders added prepays to adjustable rate mortgages. Imagine you take out an adjustable rate mortgage with a low fixed rate for just 2 years, only for the payment to spike dramatically once that intro period ends. That likely means you need to refinance or sell before that rate adjustment hits. But then comes this nasty little surprise.
What do you put in here that makes it taste so good?
That good vanilla from Mexico. And something else real special.
Buried in the fine print is a massive prepayment penalty waiting to trap you in a loan that you can no longer afford. And these weren't small fees. Like, these were commonly between 2 to 5% of the balance. I've seen prepayment penalties in excess of $20,000, which is enough to wipe out your chance of refinancing or selling the house. And these penalties are just designed to make sure banks made substantial interest profit on loans, even if you paid them off early. And they all but guaranteed foreclosure for lots of people. So the CFPB capped prepayment penalties at 3 years and completely banned them on adjustable rate mortgages. And number 5 is the decline in fair lending protections. Now, fair access to credit is something most people take for granted, but history has shown us that discrimination in lending is very real. And I don't mean ancient history, I mean recent history. CFPB has played a critical role in enforcing the Equal Credit Opportunity Act, which prohibits lenders from discriminating based on race, gender, national origin, and other protected factors. Now, this is important because the mortgage industry has a long and ugly history of redlining, which just basically means denying loans or inflated costs for Black, Latino, and low-income borrowers simply because of who they are or where they live.
What happens once they realize they have been swindled?
If they make their mortgage payments, we win. If they default, we win.
Oh, you pray they miss their nut, and then you put those houses right back on the market.
At another markup.
And by this time, it's an all-Negro neighborhood.
An entire population of Negroes who can't secure traditional mortgages.
Now, CFPB forces lenders to report mortgage applications, approvals, and denials, which makes it easier to spot discrimination and hold banks accountable, which is important because these discriminatory lending patterns have locked entire communities out of homeownership for decades. Now it's 2025. Is this still happening? Do we really need to worry about this? Well, we don't have to speculate about whether this would happen. It's already been exposed multiple times. So take Townstone Financial, for example. In 2024, last year, the CFPB accused this company of redlining black neighborhoods in Chicago and discouraging black applicants through discriminatory marketing and simply neglecting these communities in their lending efforts. Now, Townstone settled the case and agreed to pay the fine. Then there's Fairway Independent Mortgage Corporation, which targeted majority white neighborhoods in Birmingham, Alabama, while avoiding black communities. And they were forced to pay out over $8 million, including a loan subsidy program for their black residents. And let's not forget about Trident Mortgage Company, which the CFPB and the DOJ accused of intentionally redlining in the Philadelphia area back in 2022. Now that led to a $22 million settlement to help the affected communities. So these aren't ancient cases from the 1950s. This is happening right now. And the only reason these companies were caught and penalized is because the CFPB was there to investigate and enforce the law. Now, the Trump administration has already ordered the CFPB to halt all ongoing investigations, to not start any new investigations, and to stop working on any new financial regulations. So that means for the first time since its creation, the agency policing the mortgage industry is sidelined. They're not doing anything. Now, some would argue that ending CFPB will help the industry. It would reduce regulatory burdens that lenders find complex or expensive to comply with. It would also open the door to more creative financing options for would-be borrowers. And there's even arguments that costs could be reduced for borrowers because the cost of CFPB compliance is typically passed down to the consumer. But others would argue, nah, we already tried that. Before the CFPB, the mortgage industry was pretty much the Wild Wild West. And we all saw where that led. The 2008 financial crisis wiped out $6 trillion in home values. It left millions of families in foreclosure, and it triggered the worst economic downturn since the Great Depression. Now, I'll leave the judgments on whether or not this is a good idea to you guys. Tell me in the comments whether you think we can trust the banks to not make the same mistakes of the past, or do you think we need that CFPB oversight to protect borrowers from financial abuse? Now, if you need to get pre-qualified for a mortgage, there's a link in the description. And if you have questions about purchasing a home or just questions about mortgage in general, you can request a call for me at www.vawithed.com. And the YouTube algorithm thinks this video is something you need to watch, and they're usually right. So be sure to check this one out next.